The success of your retirement has a lot to do with your planning. Now, planning comes back down to anything related to your 401k, your other retirement plans, your health insurance, your life insurance, your pensions, social security, and income planning. So you can see there's a lot there that comes back down to your planning. And when we go through and look at each individual piece, that is going to ultimately help you to make sure that your retirement is going to be right for you, that you have the wealth that you have accumulated over the years to help sustain you, and you have the correct income streams in retirement. That's what we're going to be covering today. You have a lot to be considering over the next days, weeks, and months when it comes to your retirement. Now, I'm sure you have plenty of questions when it comes to what to do with your 401k. Now, in general, you have a couple different options here. Option one is that we can be keeping it where it's at in your 401k company. The second option then is to transfer or roll over the funds to your IRA account. The next option then would be to actually surrender your 401k, pay the tax on it, and put it into your bank account. And the last option that you have available is maybe you actually want to keep working and you can transfer that money to another retirement plan that you have. Well, those are the general options that you have available. And what's going to be right to you really comes back down to your retirement and what you want for yourself. You see, when it comes to option one, where we are keeping the money in the retirement account, some of the things that you need to be considering, well, do you need the money from that account? And if so, are you allowed to take distributions out on a monthly basis, or is it just a one-time amount? How many distributions can you take out on an ongoing basis? Do you have just the ability to set up a monthly amount, or can you start doing one-time amounts whenever needed? So these are things to be asking your HR as you really look into the details more. Well, the other nice element of your 401k is that in general, your employer may pick up some of the fees attached to that account. So this actually may be a lesser fee type of a feel for you as the plan participant. Now that could be different than, say, an IRA account, which may or may not, depends on which IRAs we go into and how they're working. They may have higher fees attached to them. So those are some of the details that you need to be considering. How much money do you need from your 401k? How can you take the money out of the accounts? And then the fees attached to the 401k itself. Well, again, when we look at the IRA account, the biggest difference here is going to come back down to the investments. You see, the 401k itself is going to have a limited number of investments, and in general, you probably will not have the ability to make adjustments along the way. So you have maybe 15, 18, up to maybe 25 different investments you can be going into, whereas the IRA, in really essence, the sky's the limit. We can have a lot of different types of investments related to stocks, ETFs, mutual funds. Maybe you have bonds that you want to be adding in, or bond funds that you want to be adding in. Maybe you want to have some alternative investments such as gold, or even some cryptocurrency that may not be available in your 401k. So these are all different types of elements to be considering. And this helps to have a diversified portfolio. You see, every different investment that you add in is really having the ability to help to make sure that you have money put away for today, tomorrow, and in the future. But picking those investments obviously are going to be vitally important there as well. But again, those are some of the elements and some of the differences to be considering. Then we also have, should you be surrendering your 401k? Now this I want to caution about, because that will make it taxable in the year that you surrender all of that money to put into your bank account. Now the taxation may be more than what you are anticipating, and it may put you in an adverse tax situation for this year. So those are elements to be considering. But then the last element, should you be rolling it over to a new retirement plan, that is going to go hand in hand with a new employer. So there's many elements to be considering, but know this: the one you pick is obviously going to be really subject to what's going to be right for you and the abilities that you have to not only grow the money, but take the income at the lowest amount of fees possible in the future. The next element that you'll be considering then, do you have a pension? You see, not everyone has a pension, and you may be blessed to actually have one, but you actually have some options now to choose of how to take that pension. So when you take a look at it, generally speaking, you're going to have a 100% payout that you can have to yourself. That's called a single life type of pension. Well, this type of a pension will be such that it's only going to cover your life. So all of the numbers that you see are going to be covering your life. Well, you can also cover your spouse's life too. And you can do that on what's called a period certain, whether it's a 5-year or 10-year certain payout for a beneficiary, whether you want to do a 50%, 75%, 100% joint option. You see, all of those mean something, and especially the joint options will make it such that you will receive a payout, and then your spouse will receive a payout as well in the event of your passing. Now, this is a very good option to consider when you have a difference of age, or whether your spouse is most likely going to outlive you. Because what's going to happen then is no matter what, you can make sure that your spouse is taken care of. And that's one of the biggest things that helps to improve your overall success in retirement, not only for yourself, but also for your spouse. So taking a look at those details is going to be vitally important. And the pension is going to be one key element to your overall retirement success. Now, obviously don't fret. If you do not have a pension, there's going to be some other elements that you can do to actually help create a pension for yourself. So we'll be talking about that here a little bit, but just to know that the elements and the options that you have as part of your pension is going to be vitally important to choose from, and looking into the key details of what the dollar amount is going to be a big piece of it. But then those other elements, those period certain and the joint survivor options, are going to be vitally important to help with your family. Now, that's again what I know you want to be helping to take care of, not only yourself in retirement, but also your family. And those other elements, really consider. And you can do a lot of planning around this as well, because there may be some small differences in the ways that you'd actually want to take one of those joint survivor options that are available. But again, talk to HR to know your own numbers. The deferred comp is another payout that you may have coming to you. Now, deferred compensation is something that you may or may not have, and is based upon money that you have set aside over the years. And what this would be is another element of your retirement package. Because when you set aside money for retirement, you did that over the years when you were working. Now, what this did is it took money out of your account, it put it aside into a fund that your company was managing. And the whole idea is when you retire or when you were laid off, that it would start to pay a monthly or maybe even a yearly amount to you. Well, that is something to be of note as well, because if you have this money coming to you and it's something that is going to be coming for maybe another number of months, if not another number of years, on an ongoing basis, you may not have to take out nearly as much from your retirement accounts and your retirement plans. So those are some of the things that you're going to be taking a look at. And the deferred compensation is still income. So you still will have to claim it as income. It was just deferred income, one that you didn't have from working, and now you can actually be having in retirement. So it's another element as part of your overall retirement package, and one that's going to be providing income streams for you. Now again, this is something that if you have other retirement plans, you're going to want to take a look at the different types of plans you have and when and how you should be taking money out of those accounts in light of your deferred comp. But just know that the deferred comp will be paying out, and again, talk to HR for your specific benefits as well. Up to this point, we've been talking a lot about your retirement plan and the money you have set aside for retirement, but there's one other key element that I'm sure you have plenty of questions on, and that comes back down to your health care. Now, you may have had your employer, your company, paying health care for you while you were working, or maybe it was heavily subsidized for you. But there's going to be different elements now that you are retired. And one of those key elements is if your company is actually going to be picking up the tab and paying for some retiree medical benefits for you. Now, knowing that obviously is going to be important. And again, whether your company actually will be paying for and picking up some of those ongoing monthly fees, or whether you're going to be in charge of all of your healthcare in the future, is going to come back down to the company. But what we want to do then as part of your overall retirement is to take a look at where you will be receiving your health coverage from in the future. So let's take a look at some of the elements then, and it comes back down to a short-term element with COBRA. Now, this is probably something that you're very well aware of, the 18-month rule with COBRA, and this just continues on the healthcare that you've had from your company. Now, you pay for the full amount out of pocket, so it's not something that's being subsidized. But what this does is give you options. It gives you options not only to take a look at what's going to be helpful for you in the future, but give you a little more time to determine that as well. So when you take a look at and maybe even subscribe to your COBRA benefits, what that's going to do then is, like I said, allow you the opportunity to take a look at the other benefits that are out there. Now, maybe your company actually does have a retiree medical type of plan that's already available for you that you can just actually go onto. That's going to be very helpful. Well, if they don't, you are going to be subject and wanting to find your own plan. Now, like I said, COBRA is only a very short-term in nature, so that's just to get you through until you can find the better plans. Now, there are many great plans out there, and maybe you even are coming up to Medicare age. Well, with Medicare and with all the different elements of Medicare, there's a lot to be considering here, and that's another topic that we can be discussing at a future time. But for now, know that what you do with medical is actually going to have a very big impact for your family as well. So knowing the options are going to be vitally important. Now, if you don't know the options that you have available to you, I would highly suggest finding a health insurance broker. Now, what these people do is really help with respect to knowing all the different plans that are available to you and guide you through which one's going to be the best possible fit for you and your family. And they can even take a look at your employer plan to see if you should stay on your employer plan or if there's going to be one that's going to be more helpful for what you want to do. So take a look at that. Know your health insurance and know that you have not only options available to you, but you have people that are right there that are going to be able to help answer any questions that you have. Another insurance that is often forgotten when it comes to retirement, life insurance. You see, obviously you have a lot to be considering here when it comes to just the retirement details in general, but don't overlook your necessity and needs for life insurance. You see, there are many different options in the same way that we have different options with medical or even your 401k itself. Your life insurance is something to be really considering strongly. Now, when you were working, you had a multiple of your pay. So maybe a 1 times your salary or 5 times your salary if you paid up for it, that it would help pay for life insurance. You could even have coverage on your spouse or even your children. And these are through group policies. Now that all goes away when you retire. So what you would like to look at then is specifically, first and foremost, the need for life insurance. Now, life insurance is guarding against your passing. So what key elements do we need to guard against in retirement? Well, a lot of times it comes back down to if you have children, so especially minor children that are going to be in need of whether you just schooling in general or college planning, to income planning for your spouse. Maybe you need some more additional insurance to provide those gaps that go away with respect to your pension or Social Security. Life insurance can actually pick up a lot of those different income elements that may go away if something ever happened to you. So know this, that life insurance is still vitally important, but having that need is going to be there. So take a look at where you're at for your overall wealth. Take a look at the needs that are still out there, whether it's with your children, whether it's with income replacement or whether it's for taxation in the future as part of your estate, or maybe even the fact that you want to be helping to leave more of a legacy. All of this can be solved with life insurance. But again, this is something that is going to go away as part of your employer, so you're going to need to get a permanent or even a term type of a policy. And some are more expensive than others. Some are going to have more bells and whistles than what others will. And knowing what's available is going to be very vital and helpful. So I'll give you one element here that I consider when I'm working with a number of my clients is specific types of policies that help pay for long-term care. You see, there's a lot of different types of insurances out there that can be paying for just death benefits in general, but specific policies can actually start picking up the tab for long-term care. So when we talk about the needs of retirement and the needs as you grow older, maybe it is important or vitally important to have a death benefit for just income replacement. But maybe it's also one to say that in the event something happened to you, like a long-term care need, you can have one that pays out. So look into life insurance as another way to make sure that you are going to be taken care of in retirement. With a lot to be considering with respect to retirement, we don't want anything to fall through the cracks. Now, one key element that you may not be considering right now comes back down to beneficiaries. You see, beneficiaries are such that the money that you have, the wealth that you have accumulated, if something ever happened to you, can be transferred to the ones you love or even different entities and charities. But sometimes life happens. I totally get that. And when we take a look at all of the different beneficiaries that are out there, sometimes they may not be the ones that you want on your accounts. So what we want to do then is take a look at where we're at for a beneficiary on your retirement accounts and any other accounts that you have to make sure that they're going to match what you want. Now again, that's going to be helpful to make sure that they transfer the accounts to the people that they're going to be intended to. Whether you have a change in your family dynamics, or maybe you even have new beneficiaries that have cropped up in the way of kids and grandkids that you want to add in. All of that can be done, but it's just a matter of going back through and reviewing all of your beneficiaries. Not just in one plan, but take this opportunity to review them all to make sure that they're covered and that you have the beneficiaries that you want on each individual plan. Hey, it's Nathan Krampe, and I create these videos because you are likely very ambitious when it comes to your overall wealth plan. Now, we have a lot on this channel that we look at with respect to income planning, retirement planning, as well as all the different key elements to your overall wealth plan. So subscribe below and like this video so you're being kept up to date on the additional elements to be considering when you take a look at your overall retirement package and the plan that you have in place. Now, as you're considering things, also take a look at your employee stock purchase plan stock shares. Now, remember, what these are ways that if you have a company that you've been buying shares on a quarterly basis into these types of plans, this is money that's going to be available for you, or shares of the company's stock that's going to be available for you in the future. Now, this is something that you may have been receiving at a discount, so you may have bought over the years, and now you can actually use them as part of your overall retirement package. Now again, these are things that you've been buying over the years, so you could have used them for anything. But when we come back down to having the money available for retirement, this is actually vitally helpful, because this type of stock has been something that you've been purchasing over the years. You have a cost basis associated with it, and it's something that you may have had some growth. So now we can start to say, well, if we have some growth associated with it, it's different than your retirement plans. This is something that is a taxable account. So you don't pay tax on every dollar you take out of this or sell as part of the stock. You only pay tax on the difference between what you bought it for and what you sold it for. So what this could mean to you is having a lower capital gains tax than maybe what you would have if you took money out of your retirement plans. So why I bring this up is because if you have these types of shares, your stock purchase plan shares from your company, first and foremost, they're your shares, so you can take them with you. But then second element is going to come back down to some of your planning, because when we take a look at taxation and where the best possible uses of the accounts are, maybe we actually want to lower your taxes in the next few years for various reasons. Or maybe we want to take more out of your retirement accounts and supplement with these types of stock shares that you have. Everything's on the table here, but that plan that you can be putting in place is vitally important, knowing that there's different taxation that can be done and how you can actually be lowering your taxes overall just by doing some planning. Now, obviously this is not a guarantee, but when it comes back down to your own personal plan, consult your tax accountant as well, and they can be going through some of the details there. And when you put a plan in place, especially for retirement, taking from different tax buckets is going to be very helpful and mathematically actually going to help with taxes in the future. So just know that your stock purchase plan shares are a vital element to that. Other elements then that you can be considering comes back down to everything with respect to your non-qualified stock options. Now these are ones that you may have had granted to you over the years from your company, and you may have ones that are going to be able to be exercised on a yearly basis. Now, stock options are fantastic because they're something that if the stock is in the money, these options then will give you value. But when you retire, things change just a little bit. Now, your company may have an accelerated vesting schedule, so all of a sudden those can be vested and able for you to exercise them, or they may actually force you to exercise them at a certain point in time. But when we take a look at it, just generality here is that you have 10 years from the time that you have been granted those to the time you need to exercise those options. And if done correctly, and you take a look at when those exercise of the options come due, well, then you can start planning out the income streams that are associated with it. And again, if we know that those are going to be coming in on a yearly basis, well, then we can start planning for other sources of income. Maybe we want to be taking more from your IRA accounts this year or less from your Roth IRA accounts next year. So when we come back and take a look at the different elements of your retirement accounts, well, it comes back down to your stock options as well. And that's a great piece to have, and just one to know the tax treatment as well as how it's going to affect your overall plan. But stock options are going to be a vital element for a successful retirement. Restricted stock units or RSUs are another element to your retirement. You may or may not have them, but it's good to know the differences in how they are compared to the non-qualified stock options. Now, RSUs in themselves are completely different in the respect to how they're really structured than the stock options. And the benefit to you is that they're always going to have a value because they're granted to you with a $0 share price. And so anything of the share above zero for your company's stock is going to have a value to you. Now, the hard part about these though is the fact that there's what's called an accelerated schedule for exercising these. And it may actually be so that when you retire, all of those shares may become exercisable. And you do not have really an option of these, either to postpone them or not. If they are exercised, even in the year that you retire, or maybe they're postponed by a year or two, but all of that comes back down to income. So just knowing that these are going to be available, knowing that these will be exercised, and that the money is going to be there for you coming in as the form of cash, well then that will be another element to your overall income for that year. And knowing that, obviously again, we can go back and make plans and changes to your income for the year to make sure that you are going to be taken care of and not paying too much in tax by taking too much out of the other accounts. A bonus or a severance package may actually be very beneficial and helpful for you. Now, your company may give you a severance package which would amount for maybe a couple weeks that would be paying you, or even up to a number of months that it may pay out income to you. Now, this is helping bridge those gaps. And so when we take a look at what gaps exist, it's usually between where you're at today and whether you're going to be fully retiring or whether you're going to be going back to work. Now, this severance package will again help bridge that gap so that you can really plan correctly. So it's going to be income that's going to be coming in. And during this period of time, if you are going to be retiring, well, maybe we want to be looking at other streams of income to be augmenting with that and supplementing that, I should say. And some of those streams could be coming from plans that are, well, money that's already been taxed. So maybe it's a bank account, or some of those capital gains type of accounts that maybe you've already paid the capital gains on, or it could even be Roth accounts or life insurance loans as well. So all of that can offset and help to supplement some of this income. But knowing if you're going to have a severance package will be, again, helpful. Now, if you are going to be working, you don't have as many options tax-wise then, because this money is going to be paid out, it's going to be taxed, and then if you start a new position, obviously you'll have more working income from there. But the severance package is a great benefit that you'll receive from your company for retirement or whatever you choose going forward. Speaking of work, maybe you do want to go back to work, and I really do think it's something that you should consider. Now, it doesn't have to be full-time, or maybe it does. Maybe you want to go back full-time. But what you should actually be considering then is maybe going back part-time. You see, there are many different options that you can be working on, even part-time in retirement, that are things that you actually really want to and love to do. But what this will allow for is just give you that sense of not only accomplishment, ability to get up in the morning, to have a joy of the day, but doing something you love. You see, you've had many years of doing things that maybe you've done just for the money, or maybe you've actually really loved the position, but it's not quite the same as going to work for a hobby. And so taking a look at those different streams of income could be very helpful when it comes to part-time work. So whether you work full-time, whether you work part-time, or maybe you even do a consulting role, all of this is going to help supplement income in retirement, and it's actually going to help prepare you for retirement. You see, it's sometimes really hard to go from being fully working and getting up every day and going to work to having something that after a few weeks is not really feeling like vacation anymore. This is just an ongoing everyday occurrence. And while that sounds appealing, it may actually be to the point that you may just feel a need to do something else, something different. And that's where at least working part-time may help, not only on the emotional front, but also supplementing income. While we are on the income subject, let's take a moment and talk about Social Security. You see, Social Security is something that you will receive, but depending on how you claim your benefits could be the difference of hundreds of thousands of dollars. Now, that's something that is going to come back down to, should you be claiming early, or should you actually be deferring and delaying your benefits until later on, say maybe even age 70. But when we look at Social Security correctly, you most likely could become a Social Security millionaire. You see, why I say that is because when we take a look at the average benefits between you and your spouse, combine them up, and over the course of your lifetime, there is a very high likelihood that you will receive over $1 million of benefits from Social Security. Now, if you are single, that's going to be about $500,000 that you would be receiving in benefits. But what we want to do then is figure out, should you claim early and take it maybe earlier at age 62, or should you delay and claim later, maybe full retirement age, or even as late as age 70. But when we take a look at this, we want to do two things here. We want to minimize how much money we claim from your other retirement accounts in your other accounts, and we want to maximize your Social Security benefit. And if we do those two things correctly, then you have more money to use in retirement, you have more money to pass on as a legacy, and you have more, the word of the day, options. So those are all the things that Social Security planning comes back down to. Now, the best ways to look at planning then is, in general, to take a look at, between you and your spouse, which one is the breadwinner. And they're going to have the larger Social Security benefit. Now, in general, I would suggest, again, this is something that's going to be just a general rule of thumb to take and claim that benefit later on and to delay that benefit for the breadwinner. Now, the other spouse can claim a little bit earlier, maybe even as early as age 62, depending on your needs. But what that's going to allow you to do is use the breadwinner's Social Security to cover both of your lives. You see, if something ever happened to the breadwinner, and this may be you, that your Social Security benefit will go to your spouse. And when you do that, you're going to be covering a higher amount of income for your spouse in the event something happens to you. And so having that be a higher benefit just in general is going to be helpful, but then making sure that you can get even a larger benefit by delaying the overall claim may actually be to not only your benefit, but your spouse's benefit. So actually take a look into that. But then when you come back down to the planning, it really comes back to, should you claim early, should you delay it, and what that means for your Social Security planning. Now, when it comes to the plan, go to a calculator, and you're going to find your benefits on the Social Security Administration's website. You can actually download your PDFs of your benefits, and you can take those to a calculator. And if you don't have a calculator, reach out to us, info@lionswealth.com, and we can be happy to run these calculations for you. But there's plenty of calculators online that you can find, and it's really going to figure out where your break even or your break point is going to be for claiming your benefits. And so if that's, say, like age 80, well, what that will mean then is every year past your 80th birthday, you will receive more in benefits by delaying claiming your benefits than if you had taken them earlier. So knowing where those breakpoints are for you is going to be helpful, because then what we can do then is take that and plug that back into your income streams and actually start figuring out, is it going to be more beneficial for you to claim early, or is it going to be beneficial for you to wait? But the income that you receive from Social Security is going to be one of the key elements to your overall plan, and we want to make sure that it's done correctly and not rushed. So take the time, spend more time on working with your Social Security benefits and looking up the options that you have available to you than what you may have done with your overall spring break plans or even your travel plans that you've had over the course of the summers. Take some time, because a lot of times people don't. And when we don't take the time to plan for Social Security, that's when we may make some mistakes that could be very costly to you in the future. All right, now that we have looked at Social Security, let's take a look at the other income elements that you have. You see, when we take a look at Social Security, we put together a Social Security plan. But what we want to do then is take that plan and put it into your overall income plan. So what we want to look for then is the different sources of guaranteed income, whether you have your pension plan, we're going to input your Social Security, and we're going to put that in there. Then we can start looking at the other streams of income that you potentially could have coming in from, say, your retirement accounts, your non-retirement accounts or non-qualified accounts, and some of your tax-free accounts, and we can start matching all of the income streams to your expenses. Now, basically the best way to do this then is to take a look at your expenses and to figure out which are needs versus wants. What do we need your income to be covering, and what do you want your income to be recovering? So when we take a look at needs, then it comes back down to, say, Social Security, pensions, how that covers everything related to whether it's a mortgage, whether you have utilities, cell phone bills, food bills, all of those things. We want to marry that up. But then when we take a look at your wants, travel, new car, anything else that you may have just as a want, well, now we can start taking a look at all the different ways that you have your wealth and can start cherry picking which ones are going to be most useful tax-wise and also income-wise to last all of your retirement for those pieces of the puzzle as well. So when we take a look at your income streams correctly, then now we can be looking at all the different elements. We can be making sure that you're going to have money today, tomorrow, in the future, just by marrying and matching up the income to your overall expenses. That is a vital element to the income plan. Well, up to now, we've really been talking about just some of the planning with income and how you're going to be surviving. But let's take a look at how you can thrive in retirement. Now, one of the ways we can do this is by doing Roth conversions. And how Roth conversions help you to thrive in retirement is by taking a look at your taxes today, where we can actually have maybe lowered taxes just based upon the fact that you have been retired. Well, maybe we don't take Social Security yet. Maybe we do the Roth conversion. So we take money out of your bank account for some living expenses, but those Roth conversions can take money from your retirement accounts that used to be taxable. We'll pay a little tax today on them, but we're going to convert them and put them into your Roth accounts that grow tax-free. And the more we can be making those changes, again, gives you the different ways that we can be using that money in the future tax-free. So now you have some money that is taxable. You have some money that is maybe subject to deferred tax, like your retirement accounts, and you have money now that is tax-free. And the more we put into that tax-free bucket, the more obviously you can be taking from there in the future that actually could be beneficial to you without all of the tax associated with it. So when we take a look at things, know that those Roth conversions can be a vital element. And if we do that when your income is low, if we do that when we're not taking Social Security or even required minimum distributions, well, now we have the ability to put more money aside tax-free. And the more tax-free income we have, the lower overall the possibility of our taxes are in the future. And that can be a really good recipe for success. Well, wrapping all of this up together, then we take a look at what we call your probability of success. Now, what that is then is taking a look at your income streams, the different retirement accounts and wealth that you have available for you, as well as your expenses. And what we can really do then is start planning for if you have enough money to last you all of retirement. See, if you have a very high probability of success, what that means is that your income streams and your wealth will usually cover all of your expenses. But if you have a low probability of success, that means that there is a higher likelihood that the money that you have, the income that you have in retirement, will not last all of retirement. Well, if that's the case, then you know that maybe you should go back to work, whether it's part-time or full-time. Those are different things you can be considering. But if you have a high probability of success, that's really good, obviously, just for the fact that now you have the ability to have the money last all of retirement, most likely. That's what this shows, but it's not guaranteed. Yes, you may have some guaranteed income streams, like your Social Security, like a pension, but it's not something that in and of itself that your wealth in general may be guaranteed. So there will be changes with this. But what we want to do is marry up your income streams with your overall expenses to have the highest probability that the money you have and the income you're receiving is going to last all of retirement. Now, if something happens, let's say that we don't have enough income just to take care of your basic necessities, your mortgage, whether you're having car payments, boat payments, whether you have cell phone bills, utility bills, food, all of those different basic necessities. We want to match up your income streams with that, and we want guaranteed income. Now, if you don't have a pension, or you don't have enough guaranteed income to take care of those, what the math and science dictate is that you create more guaranteed lifetime income streams. Now, the best way to do that then would be to take out an annuity. And annuities, yes, they have had bad raps in the past, but they are some very, very good investments today. Now, not every annuity is the same. So there could be actually some very bad annuities that you don't want to be invested into. And there's going to be some very good annuities that are going to match your overall objectives. But just in general, what annuities allow you to do is take money that you have from your retirement plans or from your bank accounts, and you can be putting into this annuity itself, this annuity contract, and it's going to start paying you money on a monthly and yearly basis. And that can be guaranteed for the entirety of your life, and that may also be guaranteed for your spouse or even your children's life. So what that allows for you to do is to, no matter what, make sure that all of your living expenses and all of your basic necessities are taken care of. Now, what that also will allow you to do is increase the probability of success. Because when we know that all of those elements are taken care of, well, then we have the money set aside from your other wealth plan to take care of some of those needs and wants of the future. So whether you want to buy that extra boat, whether you want to buy the house, or travel down to the Caribbean, those are all things that can be taken care of from your wealth plan itself. And when we look at your probability of success, we account for it correctly, or something that can really stand out for you. So having those different details in place, the probability of success, knowing that we can increase it with guaranteed streams of income, and the best ways to take money out in the future, all come back to saying that you can have, with a little planning, the ability to increase your probability of success and have a more happy, fulfilled retirement with that type of planning. So again, this is something that just taking that time, putting your head together with, say, your spouse, with your financial advisor. If you don't have a financial advisor, feel free to reach out. We'd be more than welcome to at least go through some of the planning stages, what we call a discovery meeting, and talk to you about the options that you have available. But that comes back down to making sure you're taken care of. Because you made it this far in the video, I want to celebrate you. You see, we've talked a lot about income streams, retirement plans, and what it means for your overall retirement. But what also is going to be on your mind is figuring out that probability of success. And so what I want to offer you is a special one-on-one consultation. Click the link below, and now it's going to take you to our contact page where you're going to fill in your contact information, and there's going to be a message section. In that message section, put the word video. Now that will allow us to get in contact with you, and we know that you watched this video. Now off of that, this will be a complimentary consultation, and the expectations are we're going to be taking a look at where you're at today, where you're going in the future, and then seeing if there's any gaps that exist. The more we can fill those gaps, the higher probability that you're going to have of a successful retirement. And that is where we want to get to help you have a successful retirement. So again, click the link below and set up your discovery meeting. For more tips and tricks on income planning, retirement planning, as well as your overall wealth plan, click this link right here for a special video that I've hand selected just for you. I'll see you there.